Yesterday, the FOMC met, and boy, did they set asset prices on absolute fire. Of course, what exactly did the Fed do? Well, first, let's look at the current market conditions. If we go ahead and we look at this ridiculous meeting that goes on, is that the October price and cost reports altered views on pressures, according to Fed Chairman Jerome Powell. Now, if you go ahead and you look at this, there's a 2-decade high becomes a near 40-year high. Inflation is so high, we don't ever know what to do, because we ain't seen this in 40 years. 6.8% inflation. If you look at the change in employment, we are down. What the hell is going on? Not good. Then also the change in quarterly employment costs is the biggest gain since 2004. Consumer prices are up. The cost of employment is up. Things don't look great. So what exactly can the Federal Reserve, the Central Bank of the United States, do? Well, technically they have two tools. They can basically go ahead and they can manipulate interest rates, or they can use tools like quantitative easing. The Fed has decided that they are going to speed up their tapering, and they should be done buying bonds by mid-March at this pace. Now, for those that don't understand what this means, basically the Federal Reserve is going into the financial markets and they're buying assets. Yes, some could say they're gambling. Others could say, no, they're just simply buying bonds and they're trying to prop up the market. They're trying to basically provide liquidity and stuff it in every corner of the economy. Whatever you want to say, they've been buying bonds and they say that they're going to be done in mid-March. We'll see. They also will signal that they are going to do 3 rate hikes in 2022. Now, this is something akin to them saying, right now, we're not going to raise interest rates. So that's clear. They did not raise the rate yesterday, even though inflation's at 6.8%, even though they claimed that it was transitory forever and they were wrong. They now say that they are signaling 3 rate hikes in 2022. That does not mean that they're guaranteed to do it. All that means is, oh yeah, we sort of kind of may possibly think about raising rates in 2022. We'll see. And so if you go ahead and you look at that inflation, then you can see that the committee sharply ratcheted up its inflation outlook for 2021, pushing it to 5.3% from 4.2% for all items and to 4.4% from 3.7%, excluding food and energy. For 2022, the expectation is now 2.6% for headline, LOL, and 2.7% for core, LOL. Now, my favorite part of this entire thing, if we can go back 1 second, is that the committee has ratcheted up their inflation outlook for 2021, pushing it to 5.3%. But the question is, it's at 6.8. How can you just simply move it up to 5.3? We're at 6.8. So obviously there is a problem. Even though they know it's at 6.8, they only moved to 5.3. Whatever. Then if we continue and we say, well, how exactly did the market react? Very simple. Bitcoin rallied from a low of $46,650 to over $49,000. Bang, bang, boys. And then bonds, the 2-year spiked from 66 bips to 71 after the announcement and has drifted back down a little bit. So ultimately, what we get here is asset prices popping. This is the S&P 500. What you can see is pretty clearly when they had the meeting yesterday and they made their statement, stocks, they like this, baby. You're not going to raise interest rates right now? No problem. Let's go back to the moon. And ultimately, what we are watching play out here is the fact that the most important aspect of the entire financial market, the most important data point, is the interest rate. If they were going to head and they are actually going to hike that interest rate, then you should expect asset prices to sell off. If they don't, then it's basically a green light. And they're saying, keep going, you crazy maniacs. Keep YOLOing into the market. Keep going levered long and keep making money. That's exactly what the Fed approved yesterday, is they basically said, you guys got 3 more months, game on. And so ultimately, here are 2 quotes. We've got one from Jerome Powell, the Fed chairman. He said that, quote, economic developments and changes in the outlook warrant this evolution of monetary policy. The economy has been making rapid progress toward maximum employment. And then on top of that, they said supply and demand imbalances related to the pandemic and the reopening of the economy have continued to contribute to elevated levels of inflation. Now, I want to make 2 things very, very clearly. Is one, the Fed has officially decided they are going to retire the word transitory, as we have talked about ad nauseum. Way before we started this show, since day 1 of this show, it was never transitory. You cannot create trillions of dollars or borrow trillions of dollars and stuff it throughout the economy and expect there to be no negative side effect. Of course, inflation was going to be high. Of course, it was going to be persistent. And so every single person that you heard claim that inflation was transitory officially is wrong. On top of that, the second thing is that they keep saying that we're getting closer and closer to maximum employment. No, we aren't. What are they talking about? There are over 10 million open roles in America. Now, on top of that, what they'll point to is not the open roles and getting those filled, but instead they'll actually point to something called the unemployment rate. Many of you understand how this works. But ultimately, what we're watching is there's lots and lots of people who just aren't participating in the legacy system anymore. I'll give you a couple of examples. If I'm an Instagram model and all of a sudden I stop having income, am I unemployed? Did I lose my job? Did I quit my job? How am I calculated? What if I'm a podcaster? Did I lose my job if all of a sudden my revenue goes to zero? What happens if all of a sudden I don't do it anymore? Did I quit my job? Did I get fired? Is that an open role in the economy? Or you can even move to things like in the digital financial system. What happens if I work at a DAO and I'm getting paid for my contributions? Then all of a sudden I stop working there. Is that an open role? Is that a firing? Am I unemployed? How does that work? And then, of course, even better is, well, what happens if I'm actually unemployed, but rather than try to go find a job, instead, I just consider myself an investor now or a day trader. And I'm literally investing my assets, no matter how big or small, and simply being able to generate some level of income to live off of. Technically, I don't have a job, but also, according to the government, they would love for me to be labeled as self-employed. So what exactly is in these metrics? Well, you can manipulate them however you want. And that's ultimately the point. If you believe that employment is actually getting materially better and we're nearing full employment, there's a lot of nonsense that I can sell you. Instead, what I think people should start to pay attention to is that inflation is incredibly high and people cannot hire for tons and tons of roles across the economy. Well, some of that's because the government gave those people free money. Some of that's because people found other ways to make income. And some of that, frankly, is just because as a society, there's a lot of people who don't want to do a lot of types of jobs that need to be filled.